Home prices will fall by upwards of 10% in 2023, at least that's according to Fortune magazine, who in January released a write-up comparing Zillow's housing market predictions with Moody's housing market predictions for 2023. Zillow is one of the largest real estate marketplace and data companies in the world. They do revenue of over $8 billion a year, and Moody's is one of the largest investment rating agencies in the world. They're one of the companies that's in charge of rating mortgages and mortgage-backed securities. Both Zillow and Moody's released a report on where they think the housing market is going in 2023. And to save you the time of reading through and analyzing both of these reports, I'm going to do it here. But if you do want to read the reports, I will link them for you down in the description. Let me start by talking about Zillow, who's the more bullish, meaning more optimistic about the housing market, because in 2023, what Zillow is saying is that by the end of the year, home prices will fall by an average of 1.1%. And the reason why this number is significant is because at the end of 2022, this number wasn't negative 1.1%, it was actually positive 0.8%. So in the last just month or two, Zillow changed their projection from a positive growth in home prices in 2023 to now a slight negative decline in home prices in 2023. And to put this in perspective, in 2022, home prices rose by a positive 10.4%. Moody's is a little bit more bearish, meaning not so optimistic on the housing market. What they're saying is that by the end of 2023, we're going to see home prices fall by 5.1%, and that we're going to continue seeing home prices fall until we see home prices fall by 10% off of their highs. Now again, just like with Zillow, the interesting thing here isn't just the number that they predict, but rather the trend. Because just a few months ago, in the end of 2022, Moody's was saying that home prices will fall in 2023 by 0 to 5% at the max. Now what they're saying is that their base case is that home prices will fall by 5.1%. You'll see what I mean by base case in just a second. The thing with both of these headline numbers, though, is that they're just averages. Meaning some neighborhoods in America might actually see home prices grow, while others will see home prices fall much faster because these are just the averages. Like, take a look at this chart. This is Zillow's expected shift in the housing market in 2023. The red areas are where they expect home prices to fall, the green areas are where they expect home prices to rise, and the dark red is where they expect home prices to fall the most. The dark green is where they expect home prices to rise the most. But this is where now things get even more interesting, because it's negative 5.1% that Moody's is giving as their headline number is their base case. And their base case is assuming no economic slowdown and no recession in the United States. However, what Moody's also said in the report is that if we see an economic slowdown and a recession here in the United States, then they're not predicting a negative 5.1% decline in housing prices. Then what they're saying, if we see a recession, is a negative 15 to 20% drop in housing prices. Again, this 15 to 20% drop that Moody's is predicting if we see a recession is the average, meaning some areas could fall further, some areas would not fall at all. And to put this in perspective, when the 2008 crash happened, between the 2006 highs and the 2012 bottom, home prices fell, so I'll write this here, 2008, by 27% on average. This is again an average. You had some markets like the Detroit market that got hit way harder than a negative 27% drop, which is why in this case, Moody's is also saying that the overvalued markets will fall by more than this. They're saying that they will fall by 25 to 30% in this recession scenario. If you're wondering, some of the areas that Moody's says is significantly overvalued is Boise, Idaho, and Las Vegas, Nevada. This is where things get even more interesting when you dive into the analysis as to why Moody's came up with this number and why Zillow came up with this number, because they both have to do with interest rates, but they both analyzed interest rates very differently. Now, if you do want to stay up to date on what is happening in the housing market with interest rates and everything else, then you can join something like Market Briefs. It's my free financial newsletter where every day my team is breaking down what's happening in the financial markets, from things like the housing market, the stock market, the global economy, our own economy, and crypto, into a fun, witty, and easy to read email. You can read Market Briefs in less than 5 minutes every morning, and it's completely free. So if you haven't joined Market Briefs yet, I'll put the link to how you can join for free down in the description below. According to Moody's, the reason why they're expecting home prices to fall more aggressively isn't because they're predicting mortgage rates are going to rise significantly. It's because what they're saying is that mortgage rates are going to stay above 6% for much longer than expected. And if we do see a recession, that means people will lose incomes, which means that you'll have even lower demand for people to buy homes, which is why if we see a recession, you'd have even a more aggressive drop in home prices. So what Moody's is saying is that the high mortgage rates are going to be staying around longer than expected, which will put a downward pressure on the housing market. Zillow, on the other hand, says something a little bit different. Actually, it's the complete opposite. Because what Zillow is saying is that the worst is behind us. What Zillow is saying is that mortgage rates peaked at just above 7%, and now mortgage rates are on their way down. And now because the worst is behind us, we're not going to see that much pain in the housing market, because Zillow didn't mention anything about how an economic slowdown could affect the housing market, and they didn't say that mortgage rates will continue to rise. They said that mortgage rates are going to continue to fall throughout 2023. Now, the important question for you is who's right? The interesting thing that I'd like to point out here is that Zillow is more on the bullish side, that they have a lot of optimism about the housing market. Moody's, not so much. But both of them still are predicting home prices to fall. Obviously, Zillow is saying the home prices are not going to fall much, but Moody's is predicting a more significant drop in housing prices depending on what happens in the economy. The common denominator between Zillow and Moody's is mortgage rates. Both of them are saying that mortgage rates are going to dictate essentially which way the housing market is going to go. Zillow says that mortgage rates are going to fall. Moody's says that mortgage rates are going to continue to stay high. So if the question comes down to mortgage rates, we have to look at what direction mortgage rates are going to go. There's two factors that determine which direction mortgage rates go. I just made a video recently that covers this topic in great detail, so I'm not going to go over it right now. But the two things that affect mortgage rates are, one, what the Federal Reserve Bank does with interest rates, and number two, inflation, because inflation affects bond rates, and these bond rates will then affect mortgage rates. Right now, it looks like mortgage rates are going to continue to rise. The Federal Reserve Bank just raised interest rates again, and what they're saying is, yeah, that they're going to continue raising interest rates. They might not be as aggressive. We don't know how aggressive the Federal Reserve Bank is going to be, but the one thing that we keep hearing is that the Federal Reserve Bank does not want to cut interest rates in 2023. So on the Federal Reserve Bank side, it looks like interest rates will have upward pressure because of that. Then on the inflationary side, what you have to know is that high inflation also pushes interest rates higher. Lower inflation pushes mortgage rates lower. So now we're in an economy where it looks like inflation is falling. We have some people saying that inflation will rise again. Other people are saying that inflation has already peaked. So this is where understanding the different factors that could affect mortgage rates and then making a decision, or just understanding what's happening in the housing market because of that. If you're looking to buy a home, the main thing is you can afford the home. That means afford the down payment and afford the monthly payment. But second, just understanding, look, there's a couple of different factors in the housing market. Mortgage rates are way higher now than where they were 12 months ago. There's still upward pressure on mortgage rates, and at the same time, we also have a slowing economy. Understanding these three factors and being patient, that way you can find the best opportunities for yourself. In October 2005, at the peak of our last housing bubble, Ben Bernanke, who was then the chairman of the Federal Reserve Bank, said, not only are we not going to see a housing bubble burst, we don't even have a housing bubble.
So we have so many economists coming on our air and saying, oh, this is a bubble and it's going to burst and this is going to be a real issue for the economy.